Hi, this is Yoder. I wanted to do a quick video today to just talk about survival, something that people tend to forget in the markets. You see a lot of new beginners coming into the markets, very exuberant, excited about the opportunities that trading can offer to them, and they quickly blow themselves up because they have taken inappropriate size and have utilized leverage in a way that is very destructive to their overall net worth. They don't spend the time it takes to actually learn how to trade, and therefore they don't survive long enough to ever reap the rewards for all their hard work and stress and risk taking. I think we're kind of in that same cycle now, except the market is pretty much systematically destroying so many different trading styles that even the old time veterans are going out there and having a real hard time justifying getting up every day to trade these markets. I want to talk to a little bit about why and how to address these issues, how to adapt your trading to survival mode, and get through this tough time as we wait for what I believe will be the best trading market of probably my entire career into 2009. Essentially, we're looking here at a daily chart of the S&P 500, expressed here as the SPY, the S&P 500 index proxy, and we're looking at the Obama bear market. Essentially, the market after the inauguration has done nothing but collapse. It has done so about 20%, which puts us into a bear market since inauguration day. The reason for this is the amount of government controls that have been instituted, the lack of transparency. Remember, Wall Street hates anything that they can't think about, research, and discount. We haven't been able to discount what the Obama administration is implementing because, first of all, there's too much, and it takes time to really think of all the different ramifications. But also, there's been an incredible lack of transparency in a lot of different places. That translates into fear, justified or not, and fear is what we see on this chart. Now, another thing that's been hurting, especially my friends in the intraday trading market or the swing trading market looking for multi-day moves or multi-hour moves, is the incessant amount of television. I don't know if you've noticed the difference during the Bush administration. You barely saw anybody on TV. There wasn't a lot of interaction. Now, all of a sudden, there's incredible communication. Seems like there's a press conference every few days. Obviously, this is, of course, due to the transition period, appointing a cabinet, and making all kinds of new policy announcements. But still, the result is that the market can never go more than a day or two without some major external shock event. And we can see that again and again in these wide volatile bars, the hashing sideways action. And if you look intraday, there are many days where the market will pick a distinct trend, begin moving in a pretty normal manner. Then someone comes onto TV, be it the president himself, Geithner, somebody from the Treasury, or Bernanke. The market will just go dead in the water, begin to base sideways, and then begin gyrating violently as it responds in knee-jerk fashion to what these people are saying. That has pretty much destroyed most support and resistance trading methodologies, most trend following methodologies, and it really leaves us in an awkward position looking at formerly very productive trading strategies that now are, if not into universal failure, certainly into nothing more than a kind of a break-even morass. Again, it's because of all this market external order flow, in my view, very much the same as we see on an options expiration day. Options expiration, you have a day where the market may set up in the morning long or short based on internal supply demand. Then you have this enormous amount of order flow coming from an external source, the options markets, as options traders come in to square their positions. And that creates a day with that's traditionally very destructive for most trading setups. And it's because of the external order flow that's being triggered. And now that's what we're seeing pretty much on a daily basis, at least 3 days a week, I'd say. It's pretty safe to say. So how does one trade in this environment? Obviously, the way to survive with 100% guarantee is to not trade at all. And granted, that's not an option for most people, but I would argue that over the last 2 to 4 weeks during this whole sliding down move, if you weren't trading on a weekly chart, you probably had a pretty frustrating time trading intraday or on a daily chart. We had this one rally to resistance here, but a very wide bar and not a classic bear flag at all. So I've been spending a lot of my time researching in the lab, looking for new ideas, looking at my old ideas, going back into my trading history, finding the strategies that used to work well for me, and starting to bring some of those out of the archives, dust them off, and see if they apply in today's market. I've also been dropping down into smaller time frames when trying to keep my time exposure to a minimum. For me, most of my failures in the last couple of months have come from trades that set up and ran for me, thus proving that my entry points were correct and carefully and properly executed. Then they fall apart based on some kind of a news event later in the session, something I couldn't have necessarily predicted, and therefore really isn't my fault. It isn't the fault of my trading plan that the situation went from a positive back towards the negative. So in order to avoid that, I've been constricting my time frame, or my time exposure rather. So let's drop down to an intraday chart here. Here we have a 5-minute chart of the SPY, and you can see pretty clearly how the market has not so much attacked, but just failed to follow through for many traditional trading styles. Here we have a gap down, so obviously people are thinking about a bearish mode for the day. Market rallies up, just fails to test either the 20 or the 40, 200 period moving average, the 40 here being the red. So the 20 and the 200 are right above, can't test it, comes back down, makes a little bit of a lower high, giving a nice shorting opportunity, but again, doesn't test the 20 period moving average, so a lot of folks weren't able to trigger that as a short, having not qualified properly. Then it moves down, comes back down again to the 20. This is the first time it's tested all day. It immediately sets up, gets everyone short, comes back up, short squeezes them, and then begins to drift down. So now what we really need to do if we're going to trade in this unstable environment, I think, is focus in the morning session. Because a lot of these news events have been happening later in the day, and you can see the wild volatility here a little bit after noon. I think that was looks like that was a news event. And then the wild overlap here and the drifting conditions into the close, probably as the result of whatever news was announced there during that noontime flush. The morning tends to be fairly stable. Obviously, it failed to test resistances here, but on a pure chart reading level, tape reading level, here we see a market that rallied up, sold off a little bit, and then spiked up to a new high and immediately sold off again, forming a bit of a double top or a peak double top false breakout scenario. So if you're watching the tape, if you're watching the actual bars being formed on either a 5 or a 15-minute chart, it can give you some insight into that morning session. That's really seems to be the sweet spot for me. A little lower high here. Again, not qualifying as a traditional trading setup, but as a tape reading setup, again, you've got a topping pattern, then a lower high, and there is follow through there. However, if you hold on to that, you're going to have some really vicious wiggles, and you're going to kind of get you in trouble later on. Let's go now back and look at another morning session. Again, here we have the S&P whipping back and forth, but after the initial movement down, find some support. Not a very clear area of support here, not particularly a pullback trade for many trading styles. A lot of people would have been buying here against the 20-period moving average, and obviously they got stopped out. But again, we do have a lower high, pretty clear lower high. This time it does interact with the moving averages, and again, we get follow through to the downside. So if you are interested in trying to keep some order flow going, some profit screeching out in spite of this bizarre intraday trading action, I would definitely recommend you look at the morning session. Just try to figure out which direction the market's going. Look for those higher lows and lower highs. Take that one trade and then be out of that market as soon as you see expansion, or by definitely as you get into the noontime doldrums, because there seems to be a lot of counter-trend movement into the doldrums as well. So that's something definitely think you ought to take a look at. Morning trading on an intraday level, kind of funny for me to think of day trading again. I did everything I could to get away from that. Position trading is certainly my love. Trading on weekly charts, holding things for months and months. But other than the short earlier this year, there really hasn't been anything on that time frame. So the intraday market seems to be the sweet spot for now. But rule number one, survive. Keep yourself careful. Trade very, very small. This is not the time to accumulate wealth or make big profits. It's the time to survive so that when the easy pickings come through after everyone's washed out of this market, that you're there and able to trade into the future. So with that, good luck and good trading. My name's Yoder. Thanks as always for listening.